Joins us. Let's connect. Let's take our conversation forward with Saurabh. Saurabh, good morning. Fantastic to have you back. Thank you for joining us. 6% down for TCS. Are markets indicating that in the short term things have run up really ahead of themselves? Because when you see a stock like TCS fall by 6%, even though numbers are marginally off the estimates, you just ask yourself why. I mean, are markets telling you that things are looking overheated and they need to calm down now?
Honestly, Nikunj, I really don't have that much concern about near-term market movements. We've never been that focused on day-to-day stock price movements, neither in names like TCS nor say a name like Titan. It neither excites us nor does it worry us when these sorts of things happen, such as life. You focus on the business, and in TCS's case, I think the business looks stronger than it has done in the last 20 years. The last 20 years, it's been a phenomenal company. So if you're a company growing earnings at close to 30%, in an industry where attrition rates for other IT services companies are 15% or higher, TCS still has an attrition rate of around 11%. Free cash flows have compounded for this franchise at 25% for the last decade. In fact, I think for the last 2 decades, it's compounded free cash flows at 25%. You speak to any global IT company, IT services company outside India. This is the Indian IT services company they fear the most. TCS's competitive advantages on the training, recruitment, and retention side are formidable. I think on that front, on training, retraining workers, I think they retrain around 2.5 lakh workers a year. It's a powerhouse franchise, very strong competitive advantages. I don't think I'm going to lose that much sleep about what the market is doing to TCS today. We've owned it in several of our advisory portfolios. We were in our both onshore and offshore advisory portfolios, and we continue to be steadfast believers that this is the powerhouse franchise in Indian IT services.
What is the right way to look at IT stocks, Saurabh? Because I don't think anybody is questioning that the relevance of IT post-pandemic has only increased. The debate is whether valuations are stretched or future returns have to be diluted given the recent run-up.
I don't think, with all due respect, Nikunj, I don't think there's a debate there. And here's why I don't think it's a debate. Maybe 5-6 years hence, there could be a realistic debate on the subject. At this juncture, it isn't, because if you see the needs of the Fortune 500 companies, where they have to digitize their businesses, reinvent their businesses comprehensively for the world of mobile technology, for the world of cloud technology, the sheer amount of work that the Fortune 500 companies have to give means that for the top 4, top 5 Indian IT services, the next 5 years, their main challenge for the Indian IT services, the next 5 years, the main challenge is to get enough workers. The challenge is not to have bulging order pipelines. So the next 5 years, Indian IT services has probably the most robust demand outlook it's ever had. As I said, the challenge is on the supply side. Can you get enough trained workers to fill the insane amounts of work that is coming from the Western world? And there we believe TCS is better positioned than any other Indian IT services. So you saw Cognizant last quarter say that they were turning away business because they can't get enough, that they can't get enough people. You're seeing other well-known Indian IT services firms report 15-20% workforce attrition. So if you have a 5-year outlook where demand is not a problem, you've got bulging order books, growth in business running at around 15% YOY on a dollar basis, net profits growing at 20-25%. I don't think valuations can rationally be explained as a concern. The concern is, can you keep your operating margin? Can you protect your operating margin from labor costs escalating as finding workers gets harder and harder?
Are you delighted and also positively surprised with the kind of commentary we've got from a Bajaj Finance in terms of lending picking up, Titan in terms of how jewelry sales have normalized, Shobha or Lodha indicating that their quarter gone by has been one of the best in the industry. Despite a shattering impact of the second wave, the consumer, Saurabh, is not in the shell. There is serious wealth effect, I think, which is back and which is getting captured in the way consumer is spending.
So I won't say we are surprised. We are obviously delighted. We're not surprised. We're not surprised because as far back as middle of March 2020, when I was doing exactly this show with you in the middle of March 2020, we were shouting to anybody who was willing to listen that COVID shouldn't be a source of panic. The Indian economy is robust. The Indian economy is resilient. India's demand is a robust demand and will recover quickly from even the exigencies of COVID. So we said it when the market was in free fall. We said it when the first lockdown was underway. We said it when the second wave came, and we'll continue saying it that this country has very strong demand fundamentals. In addition to strong demand fundamentals, the country is formalizing. Every sector you care to think about is first formalizing and then it's consolidating. If a sector formalizes and consolidates, you and I know that all you and I have to do is look for the top one or two players who've got decisive competitive advantages, good governance, sensible management. We load up on that and we benefit from the consolidation of the economy alongside the recovery of the economy. So I was amongst the people, I would say, fortunate enough to be standing in the domestic airport on Friday morning when there was something like 90,000 passengers queuing up. And it was a bit of a hassle for me. But as I was queuing up with 90,000 people, I spoke to half a dozen people in the queue, right? Some were running hotels, some were running factories, some were running hardware stores. Demand is soaring across the economy, not just for the elite end of the spectrum. Demand is soaring across the economy, and the companies you mentioned, and those companies are in our portfolios, Bajaj Finance, Titan, are amongst the many beneficiaries. I think the next 2 years, demand is not the concern. What you and I are trying to do is invest in companies who can deal with cost inflation and thus give you and me top line growth of around 20-25%, translating into consistent bottom line growth of 20-25%. That's not going to be easy because cost inflation is going to come soaring through. And therefore, our focus on market leading franchises such as Bajaj, such as Titan, such as TCS, so that we can continue generating for our clients consistent 20-25% compounding.
Good morning, Saurabh. So, if you were to remove Bajaj Finance out of the equation, and let's also take out HDFC Limited from the equation, then what you see are also the financials being laggards. Look at the Bank Nifty, for example. Why is that then the case? If 90,000 passengers are queuing up, someone are running hotels, working capital needs are there, you're seeing balance sheets also improve.
Right. So I was just looking at exactly this point before I began chatting to you guys. So if you look at it, Nantara, Bank Nifty is up, close to 60% on a YOY basis. So it's not as if they've been laggards in the sense that the recovery has left them untouched. And as you rightly mentioned, that even HDFC Bank is reporting 15-16% loan book growth, which is solid loan book growth given the circumstances. I think the reason the bank recovery in terms of loan offtake will take a little longer is, as we've all realized, the impact on COVID on small businesses is obviously more serious than the impact of COVID on a Titan or say a Pidilite or an Asian Paints or a Relaxo, right? The impact on COVID on smaller businesses has been more severe. Furthermore, Nayantara, as you formalize the economy, as you consolidate the economy, by definition, the prosperity of Titan or Tanishq means that smaller jewelers are suffering. The prosperity of a Pidilite means smaller players in that sector are suffering. So that the pain of the SME sector, which is also gain for our portfolio companies, the pain of the SME sector necessarily is gain for our portfolio companies. But what it also means is SME credit offtake hasn't yet come back. And I think that's another 6 to 12 months out. And hence bank loan books are probably not growing at the 20-25% that they used to grow in previous economic booms. Good bank loan books, an HDFC Bank, Kotak Bank type loan book is growing at around 15%. My reckoning is it'll take them another year to get that loan book growth up to a 20% mark. But even without that, net profit growth for the high quality banks, I reckon will come back to 20%. From this quarter, the quarter that just ended. So it'll take a little bit more time for bank loan book growth to recover for high quality banks. Credit quality, we are pretty confident about. I don't think that's a big concern anymore. Loan book growth, it'll take a little longer because SMEs have been pulverized by COVID, and therefore it takes a little longer for them to recover.
With just the deep value stocks making a comeback, becoming a flavor of the season again, the massive trigger you got from the government with the Maharaja sale taking off, Air India going back to the Tatas, and that was maybe the most difficult disinvestment candidate, one of the most challenging ones.
Yeah.
Is there a case now for people to look even more at PSUs?
So I think I agree with you that the Air India sale to the Tata Group is a momentous occasion. I think it's something to be celebrated. A lot of credit to everybody involved in that. What seems like a process which has gone on for forever, but a lot of credit that seems to be coming to an end. Momentous occasion, but I'm never quite sure why people get so excited about public sector stocks. As I've said several times before, the goal of a government-owned company is to serve the needs of the nation. And we are very grateful that they do serve the needs of the nation ever so well, whether it is IRCTC, whether it is Steel Authority of India, whether it is the oil marketing companies or say a State Bank of India. We ever say grateful that the PSUs are there to serve the needs of the nation. The shareholders' interests are secondary in that context. And therefore, I've never quite understood the fascination so many people have in our country, including many other institutional fund managers. Never understood the fascination with PSU stocks. Their goal is not to drive shareholder returns, rightfully so. Their goal is to serve the citizens of this vast country. And therefore, I've never understood this value investors' fascination with public sector stocks.
Saurabh, a very big change, I think, is visible in the manufacturing space. It could be China plus one. It could be the fact that there is a PLI scheme which is on, or in general, the supply chains in the world are moving. What is the best way to identify a good manufacturing company? Because typically manufacturing company follow a different process, unlike the consumer companies or the brand companies or some of the master franchises you track.
Yeah, so you're right. I mean, I'm also seeing that as we travel around the country, various Marcellus teams fanned out across India over the last 2 weeks to go and meet manufacturing companies in various parts of the nation. And we agree with your point, Nikunj, that the pullback in manufacturing, whether it is China plus one or whether it is PLI, the demand drivers are not fully obvious, but it is very clear. And we too are trying to fathom exactly why we have seen such a robust pullback in manufacturing. Now, where we are being a little bit cautious is, like everybody else, we are hearing about widespread reports of cost inflation. So labor costs rising at 20-25% for manufacturers is something that we are commonly hearing about. The news about semiconductor shortage, coal shortage, gas shortage in the Western world, those are obviously commonplace reports. And hence what we are trying to be very careful about, Nikunj, is focusing on manufacturers where we do see pricing power. So just to sort of give an extreme example, just to simplify the point, if you take a company like an alkyl amines, because of their utter dominance of aliphatic amines being an essential input for the pharma industry for API manufacturing, because aliphatic amines are a solvent for the pharma industry, and alkyl amines is the dominant aliphatic amines manufacturer, we have a degree of comfort that they can deal with the raw material cost inflation that might come through. Similarly, to take another example that we've talked about for years, in a GMM Pfaudler's case, we can see the pricing power, right? They have huge dominance in the high end of the glass-lined reactors market. They have bulging order books, and therefore we're looking for manufacturing companies where the pricing power is proven, where the competitive advantages are so strong that other rivals can't get in the way of our investee company hiking prices. So put it in simple English, look for manufacturers, but look for franchises where they'll be able to hike prices by perhaps as much as 10 to 20% this year to offset input cost inflation, which does seem to be coming through just as strong as the demand recovery has come for Indian manufacturing.
How seriously should we look at this entire spurt in energy, whether it is coal, whether it is oil, whether it is solar? Could this really shake the apple cart? Because beyond a point, consumers will find it difficult to absorb, and companies will struggle to pass it on.
Yeah. So Nicole, it's a valid point you raise. We look back at India's economic booms. Typically, we are able to do at least 2 years of strong growth. In exceptional circumstances like '04 to '08, we are able to do 4 years of strong growth. But typically, in India's case, either at the 2 year mark or at the 4 year mark, input cost inflation goes out of control and forces the rate cycle to turn up strongly, and that then dampens economic growth. I don't think we are at a juncture where we have to worry about that inordinately. Obviously, there will be tightening from both the RBI and the Fed. At this juncture, it looks all but obvious that the RBI and the Fed will tighten next year. But that's very similar to, say, what happened in 2004. 2004, the Fed started tightening. But because it was tightening at a time when growth was picking up and the outlook was buoyant, the market continued rallying for another 3.5 years before the traumatic events of 2008. So I think the hikes next year, which seem to be on the rate hikes next year, which seem to be on the cards, looks similar to me to be similar to the 2004 hikes. And I wouldn't therefore worry about the macro cycle for another couple of years at least. How do we make money through this demand recovery with energy prices rising? I go back to the point on play franchises with enormous pricing power, master franchises as you call them, or market leading franchises as I might call them. I don't have a view on energy prices. It's not something, the whole commodity price thing is not something we specialize in. All we are trying to do therefore is hedge ourselves against that roar in commodity prices by looking for champion franchises with pricing power so that their bottom line benefits from the top line recoveries that we are seeing across the economy.